Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors. August 28th, the year is slipping by. How many people back in March, early April, would have won a bet with the S&P down 30%, that by August, all three major indexes, the Qs, the S&P, and the Dow, would be positive? The odds would have been awfully attractive in Vegas for that bet. I put up a table just to give you an idea of what we're looking at from short term, 1 day, 7 day, 30 day, 60 day, out through year to date. Give you an idea of what's working better, where there's some lag. In terms of that steady trend, it's been the NASDAQ. We've spoken about that. If we lift up, though, under the hood, you're really going to see some breathtaking action out of software. Software had a monster week. It's had a monster month. You look at names like Microsoft, Salesforce, Adobe, names that drive efficiencies within businesses, drive efficiencies in our own lives at home, on personal work, thinking about what you can accomplish on your laptop or iPad or PC today versus just 5, 10, 15, 20 years ago. Marc Andreessen, who, if you've been an investor for a couple of decades and trading for a while, you know that name, founder of Netscape back in '95, sold it to AOL in the early 2000s, probably 2001 or 2, went on to fund multiple tech companies, specifically I shouldn't say specifically, but geared in the software space. He famously said in 2011, famous now, in an op-ed article in the Wall Street Journal, software is eating the world. You say, what the heck's he talking about then? Keep back. We go back to 2011. You thought about software and it was Microsoft. It was difficult to get away from a network that wasn't hardware driven. Semiconductors, Intel, Cisco on the networking side. Software was important, but not the lifeblood that it's become in our business environment today. And that's a very interesting quote when we go back to what Marc said back in 2011 and what we've seen the last few years. In terms of that liquidity that really the Fed provided to both the fixed income and equity markets back in March and April, by stepping in as a bid on treasuries, on corporates, on high-grade municipals, which was the real area of concern for us at Cumberland. That liquidity that has driven these markets has really found a home in the growth areas. So we talk about growth, we talk about value. We see value, make a little bid, and then growth reemerges. The positive, I would say, on the value side is at least that bid is sticking. Value thus far has not rolled over. You've seen the banks, the financials stay with a bid. Even energy has had a bid. Certainly not trading like the Qs are tech, healthcare, medical devices. At least there's a bid. That gives us the breadth in the markets that we want. Where's the top? Nobody knows. In terms of momentum, very strong now. It is in areas that tends to create pullbacks as buyers exhaust themselves into this ramp. But in terms of technology, software, semiconductors, very strong, getting into area that you probably want to be careful about chasing, but have them on your list for buy on pullback opportunities. We talk about long-term buckets and short-term buckets. Always important to keep an idea of having some of these dominant companies for the next 5, 10, 15, 20, 25 years. I did a review with a client this week who has been a long-term client. We looked back at one of her holdings, which is Apple, and when it was first bought, and her cost basis with the different splits in Apple over the years, her cost basis is less than $10. It's that kind of time in a great company that can be a life-changing event. So have a list. It may only contain 5 or 10 names. And when there are deep pullbacks, and there will be in the equity market, they're not outlawed, have the confidence to step in to these type of names. Have a great weekend. We'll see you next week.
Hi, it's John Mousseau. I am the president and CEO of Cumberland Advisors. It is Friday afternoon on August 28th. Summer doldrums. A week where we saw a little bit of normalcy with a rising stock market and rising yields. That's the world that we normally would expect. Rates higher, news better, inflationary expectations rising slightly. All of this is signs of an economy that is digging out from this second wave of coronavirus, which we saw hit Florida, Texas, California. Infection rates going down. Hopefully a vaccine not too distant future. If you looked at this week, you saw the 10-year Treasury climb from 63 basis points to 71. You saw the 30-year Treasury bond go from 134 all the way up to 151, a 17 basis point rise, which means the difference between 10-year yields and 30-year yields is climbing, usually a sign that the investing community is expecting better times ahead. Therefore, they're demanding higher yield the further out in maturity as you go. That is a healthy sign for an economy. We looked at numbers this week, such as durable goods, higher. We saw things like consumer spending, higher. We saw initial jobless claims come in again at 1 million. Slightly disappointing in the sense that we still have a lot of people out of work that we have to put back to work. Munis this week, pretty much just a little cheaper than Treasury yields. They weakened a little bit. You're starting to see gives in deals. You're starting to see deals not be fully subscribed, so they have to cheapen them up. That is a sign also that the bond market is starting to rise slowly in yields, and people's expectations are, hey, you've got to give me a little extra yield to get involved. So that is a different market than we had certainly in June and July and latter part of May. Again, next week, we'll be watching, of course, initial jobless claims again. But next week, we are also going to be just looking to see whether there's a continuation in the bond market. And of course, we get unemployment at the end of next week, and we'll be viewing that as well. So we hope everybody has a great weekend, and we'll talk to you next week. Thanks.